Hello, welcome. The Bakken, the Eagle Four, and the Permian Basin, the Goose that lays the golden egg. My name is Seewing Yee. I'm a real estate wealth advisor. I'm the CEO and founder of Yee Real Estate Network. Welcome everyone. Welcome my members of my network. Welcome new people that found me from whatever sources and prospective clients and others. Thank you so much for listening to this 25-minute or so presentation. Our business philosophy is that we are not married to any one real estate market. We conduct research and due diligence in various markets throughout the U.S. to find the best investment homes with the highest cap rates, cash on cash return, and returns on investments, your ROI. We help busy investors to achieve their long-term financial freedom goals by using a remote, passive, turnkey, and rent-ready investment approach. This is the Let me share with you my investment philosophy. Okay, this is very clear. I want to articulate to you my definitive philosophy of how based on the evolution of my company. I've been doing this real estate investing for many years, and at this particular point in time, I believe I have perfected a almost perfect system. I know there are others out there, but I feel this is an amazing opportunity for those of you who are involved in working with me. You will see the tremendous value of using my system and my strategies in real estate investing. And this is my core philosophy of my organization, and this is the benchmark for on my core values and my, like I said, my system and strategies, which it took me a very long time to create. Anyway, this is the trifecta of massive wealth building. Okay, could be your blueprint to your financial future. You have the ability to retire earlier and faster, and basically we can talk about creating massive cash flow, invest in the oil field rental homes. And the formula that I've been using, that I've been educating my real estate investors are 10, 10, 10, 1 million. What does it mean? It means potentially purchase 10 investment homes, retire in 10 years, and have the ability to create a $10,000 monthly net real estate passive income, and ultimately have at least $1 million in net worth without any debt. This formula is based on assuming you qualify for a full doc loan. You're buying systematically one investment home at a time with typically 20 to 25% down payment on financing, and then use deposit cash flow with each home to pay down the principal using the cash flow. Pay down extra principal or your mortgage per month using deposit cash flow that from each home. Therefore, you should be able to pay off all of your investment houses in about 10 years. Therefore, you can retire debt free if each investment home, let's say, costs about $100,000, and without a mortgage at 10 years from now, after you accelerate your mortgage and pay it off, you should have an estimate around $1,000 net rental income per investment property. Hence, that's why you see this formula works the way it is. All right, let's proceed. A little bit about me. I don't want to go through too much. I'm a popular seminar and public speaker. I have an extensive background in financial services in my 20-something years of professional consulting. I have a bachelor's in accounting, master's in taxation, and I'm retired with 20 years of service with the U.S. Army, 10 years of active duty back in the decade of 1980. 1980. to 1990, right? Then when I left the active duty after 10 years, I joined the 10 years National Guard Reserve here in California. So therefore, I have a cumulative 20 years of military service with a good pension coming out very shortly, and medical benefit and all those additional benefits, which is I'm very happy to have an extra passive income ability. And I'm also a credit consultant in the past, but however, I do not own in a credit repair company anymore, doing it for many years in the past. And I'm also a California licensed real estate broker, and I'm active member of various real estate associations. Anyway, and of course, I work as a financial planner with a major Wall Street firm back in 1989 to 2004. And I have helped thousands of clients repair their credit in the past. And since 2004, when I left the financial planning profession, I opened up a real estate network, which is a real estate investment club. And my company is growing very fast at this time. And I'm here in Fremont, California, but I have helped hundreds of real estate investors to purchase high-quality income-producing properties. Okay, so I want to share with you the 3 scenarios of how to accumulate real estate wealth using my strategies. Although there are some modifications. By the way, if you have a starting point of at least $50,000 of cash to obtain financing, 20% down, you qualify basically to benefit from the system and the strategies that I'm using on this presentation. Okay, but I'm just giving you a high level 3 scenarios of how to access your capital to use different strategies. And the first of the 3 scenario is scenario number 1. You are about to retire right now with $500,000 in traditional IRA. Okay, and scenario number 2, you want to retire in 5 years with your $500,000 IRA portfolio. Okay. Scenario number 3, a person's retirement timeline is 10 to 15 years away. For example, you have around $100,000 in cash, have good credit, and qualify for financing. So I'm giving you 3 scenarios of potentially 3 different investor, okay, given their unique goals and their objectives. All right. So before I go over the specifics, let me share with you. Again, this presentation is all about creating an initial foundation, creating initial portfolio of investing into your oil boom areas. Okay, and I will share that with you later. And by the way, I have a relationship with these three locations, whereby we have rental homes, permanent housing, single-family homes, or 1 unit of a duplex, 3-bedroom, 2-bath, typically, right? And to be purchased by my investors within my organization. So before I go over the details, see why the oil boom has created a job boom, and the job boom has created a housing boom to last for years. The opportunity to be on the front end of a market like the Bakken, which is in North Dakota, Eagle 4, which is in South Texas, and Permian Basin, which is in West Texas, Midland, Odessa area, is awesome. You only get to see it once, maybe twice in a lifetime if you're lucky. And with an oil boom creating a housing market like this, it's like a 1,000-year storm. This investing environment may never happen again in the history of civilization. Where else where you can achieve a 13 to 18% cap rate, 30% cash-on-cash returns, and 70% or more of total return on your investment, your ROI? That's a good question, isn't it? Well, I'm going to provide you with the answer. Before I do that, let's take a step back and go over the big picture. The Rule 72, the magic of compound interest. 72 divided by the the rate of return equal the number of years the properties will double. Okay, let's assume a 5% growth rate of return. 72 divided by 5% equals 14 years. So therefore, your asset, in this case, your investment property, will double in 14 years. Okay, pretty simple explanation. We'll go over that. Let's get back to the scenario number 1. All these are hypothetical, high-level discussion, of course, right? And I'm not gonna discuss, maintenance and upkeep or vacancies or tax situation because it's just, this presentation is just not geared to discuss the actual details. But for now, again, everything is examples, scenarios, high-level conceptual strategies. Okay. So getting back to scenario number 1, at retirement, most financial planners, the typical financial planners out there, whoever they are, from Wall Street, stock market, whatever, recommend to withdraw 5% of someone's retirement portfolio. This way, the retiree will not outlive their income. So using the same $500,000 in traditional IRA, multiply by 5% withdraw monthly rate or annual rate in this case, which is $25,000 per year. If you divide that by 12 months, so typically based on 5% withdrawal of $500,000 of traditional IRA, your monthly income from your stock market mutual fund portfolio, for example, is a mere $2,000 per month. Okay. Instead, my approach, my system, my strategy is to, instead of doing that, convert your IRA into a self-directed IRA and buy with that $500,000 IRA. Once you convert it into a self-directed IRA, potentially buy 2 investment property, either in a Bakken, North Dakota, Eagle Ford, South Texas, or Permian Basin, West Texas, at, for example, $250,000 each. Okay, all with your IRA cash, all IRA cash. Okay. So with the $500,000, you can buy 2 property, all in cash from your IRA. So based on the estimated gross rent of $3,500 per month, minus the applicable property taxes, insurance, property management fee, or 5% and what have you, your net income should be $3,000 passive income per property. Okay, since you purchased 2 with the $500K in IRA, $3,000 multiplied by 2, so you should have $6,000 of net income with your 2 Bakken or Eagle Ford or Permian Basin properties, right? We're talking $6,000. Sounds better than a $2,000 monthly withdrawal from your traditional Wall Street portfolio? Okay, I think the answer is pretty obvious. All right. Besides, you still have 2 potential properties with the 2 have the potential for appreciation. Of course, we're not going to discuss tax benefit. So $250,000 property per property, and to reach double the value to $500,000, equal $500,000 right now. I'm sorry. Okay, so 2 properties, right? 250 plus 250 equal $500,000 at assumed growth rate of rate of return at 5% using the magic compound interest. As I told you before, in 14 years, those 2 properties will be worth $1 million. All right? Scenario number 2. What if you have the $500,000 in traditional IRA, but are not ready to retire in another 5 years? Instead of putting all money cash down, what you could do is buy a $250,000 investment property in a Bakken, in the Eagle Ford or Permian Basin with 40% down payment from your self-directed IRA, and then use a 60% non-recourse loan secured by the IRA. Right? So 40% of your IRA multiplied by the purchase price $250, so your out of pocket, your at-risk investment is $100,000 IRA. So based on my calculation minus the monthly mortgage associated with that non-recourse loan, and based on the property taxes and property insurance and property management fee, your net cash flow each month is $2,500. Okay, so if you have going back to the $500,000 of initial investments in your IRA, you have this, and you only are able so per property at 40% down, as I mentioned. So each property you can purchase $100,000 with your IRA. So that means you can buy 5 properties, right? Right. Then you use the net cash flow, okay, to accelerate and pay off the non-recourse loan, or about $150 amount of loan on each property, based on the 60% loan to value with the non-recourse loan secured by the IRA. So view the $2,500 of net cash flow inside the IRA, instead of putting back in the IRA tax deferred, you're going to use the $2,500 of extra cash flow, rental income per month, and pay down the non-recourse loan, pay down the principal once each month. You can accelerate this non-recourse loan in about, because you have so much cash flow, you can pay it off. You can pay off the non-recourse loan in a mere 5 to 6 years. Trust me, I've done the calculation. So when it's time to retire at age 59 and a half or older, the $250,000 property, each property, in this case 5 rentals, right, is fully paid for. So assuming the rent remains the same, but who knows about the future? It may decrease a little bit once the supply catch up with the demand in all those 3 oil boom locations. But using the same scenario, you can withdraw about $3,000 monthly cash flow per property, right? Free and clear, no recourse loan, all debt free. So $3,000 multiplied by 5 investment homes in those markets equals $15,000 in monthly passive income for retirement. Sounds pretty good, huh? Instead of whatever, $2,000 from your traditional stock market mutual fund stuff, okay? So the current value of the 5 investment home in those oil field markets, equal for Permian Basin and the Bakken, equals the current value, 5 times 250,000, assuming the purchase price is $250 each rental, is 1.25, the current value. Again, using a conservative rate of return 5% over time, using the compound interest, your 5 property will double in value in 14 years. Okay, so in 14 years, double the value, 1.25 plus 1.25 equal $2.5 million in IRA. Isn't that amazing? Sounds good, huh? Scenario number 3. You're not using your IRA. You're using your cash, using your name to purchase a property at 20 to 25% down payment. Okay? Assuming you have good credit, you can qualify for full documentation loan. So, $100,000 cash, let's say you're age 40 to age 50. Most, baby boomers, for example, right? You qualify for financing, you want to retire in 10 to 15 years. Given this scenario, with your $100,000 property, with $250,000 times 20% down payment, so your total down payment out of pocket is around $50,000 per property. A few $1,000s closing costs. Okay, I don't want to be too detailed, too specific. So $100,000 will buy you 2 properties in this oil field, Bakken, Eagle Ford, Permian Basin. All right, with 20% down. So here's a scenario based on a current environment whereby you can potentially obtain $3,500 of monthly gross rent. By the way, I can always share with you the details. Okay, I'm not, I want to make this presentation only a 30-minute. If I tell you how we can get to $3,500, it'll take forever, or we can talk one-on-one, or whatever the case may be. All right. So I'm making these assumptions, so bear with me. $3,500 monthly gross rent on those property minus, your typical mortgage, taxes, insurance, whatever, your debt obligations. Your monthly net cash flow is potentially $2,000 per property. Monthly net cash flow. All right. So $2,000 monthly net cash flow per property. You're able to purchase 2 of them with 20% down payment, with your initial cash $100,000 equals $4,000 monthly cash flow. All right. Pretty darn good. Some of you can retire right now, right there, this $4,000, right? You could, but hey, if you're not ready to retire, you can have a few more years to hold the property long term, and you're gonna be good to go. So here's the thing. So I have given you 2 scenarios, almost 3 scenarios, where each of those initial 3 scenarios you can retire right now. Okay, but in this 3rd scenario, you have a 5 to 10 year holding period. Instead of the net cash flow you can achieve on this 3rd scenario, which you're buying with a regular financing under your name, instead of you can get so much cash flow. Why not save the monthly cash flow on your 2 rentals or however many rentals you have, and save those down payment on a monthly basis, accumulate them. The purpose is to you're gonna leverage. You need to understand that the power of leverage in real estate investing, especially in this particular strategy I'm sharing with you. So therefore, let's assume you want to buy a typical cookie cutter investment home, 3-bedroom, 2-bath, single family home, 1,500 square foot. Let's assume the price is the purchase price is $100,000. Where you can find them? Many places. I also have network connections with partners that also sell investment homes for my organization in various locations like San Antonio, Texas, Orlando, Indianapolis. Quite a few more markets where you can able to buy these homes for this amount: $100,000, 1,500 square foot, 3-bedroom, 2-bath. Your typical mom and pop investor cookie cutter investment home. All right, and a typical $100,000 property rent for anywhere gross rent $1,000 to $1,100 a month, with 20% down. Your net monthly cash flow after deductions around $200 to $300. All right, not bad. Positive cash flow. Okay, so $100,000 multiplied by 20% down payment equals total down payment $20,000 plus closing costs. Let's say you need $25,000 of total cash outlay to purchase one of these smaller homes. So with your $4,000 of Bakken Eagle for Permian Basin net cash flow per month on those 2 rentals, it will take you about every 6 months. Once every 6 months to buy a $100,000 property with 20% down. How? Your $4,000 of cumulative net cash flow, $2,000 plus $2,000 from your 2 rentals, multiplied by 6 months. So in about half the year, you're able to accumulate $24,000 from your cash flow. Then you can buy those $100,000 property in different locations. That's how you leverage. All right. So every 6 months. So therefore, twice a year, you have the ability to buy, properties. So in about 5 years, you can be able to accumulate 10 properties with a cash flow only. Nothing else you need to put down other than with the down payment, except using the cumulative cash flow. So each time you close escrow on one of those smaller investment property, you have $200 or $300 net cash flow, right? Do the same principle if you have the discipline and commitment. You can, instead of spend those $200 or $300 cash flow, you use those cash flow to pay down the underlying mortgage with each of those investment homes. Okay, use those extra money to pay down the principal, accelerate the principal. Okay, once a month. Okay, once a month. That you can. So therefore, you should take about 7 to 10 years to pay off each of those average cookie cutter $100,000 homes, right? So once your mortgage is paid off on all those rental homes, or those smaller ones that is, you typically have about $1,000 net cash flow per property without a mortgage, without a debt. All right? So therefore, after 7 to 10 years, you will have about 10 grand in monthly passive income for retirement. All coming from your initial $100,000 in cash. So we're not even factoring the appreciation from all the 12 properties, okay? I mean, let's cash flow is the king, I believe, and appreciation is merely the bonus, right? So, but having said that, let's go over the current value of your real estate portfolio anyway, okay? Current value of real estate portfolio. $250,000 times 2 properties equals $500,000 current value, right? Plus, at the end of 5 years, you have another 10 property. Each one is about $100,000, so equals $1 million. Therefore, you're going to have a total of $1.5 million worth in your property. At 5% rate of return growth each year, in 14 years, the value will double, so to 1.5 to 3 million in asset. No debt, right? You paid off all you accelerate your mortgages, you pay it off, of course, right? So this is it. This is your plan. Have any kind of questions? Of course, you're gonna have to consult with me to go over your each individual situation. And of course, my name is Seewing Yee. I'm the founder and CEO of Yee Real Estate Network. Here's my number, 510-552-0726. My email is seewingyee@seewingyeeseminars.com, and my website, www.seewingyeeseminars.com. And thank you for attending so much, and I would love to consult with you one-on-one. And I'm very, very excited to share this great investment philosophy with you, and looking forward to talking to you, all of you, and hope to help you reach your retirement goal very quickly, or within right now, given your financial resources you have, or within 5 to 10 years, whatever your goals are. Thank you for attending, and I will talk to you soon. Have a nice day.